We're back. So, as you may or may not know, Silicon Valley Financial Group used a bathroom in bed on themselves last week. They lost over $80 billion in 24 hours. Largest US bank failure since 2008. So in this video together, we'll cover how and why it happened, the risk of what's to come, and most importantly, how to set yourself up to be safe. We'll also cover some bank charts. And towards the end, you and I will uncover a little secret you're not supposed to know about the banking system. And of course, the one thing literally no one is talking about with these bank failures, central bank digital currencies, how it all connects. Let's dive into it. So SVB specialized in banking for tech startups and California wineries, right? So they finance almost half of US venture-backed technology companies, healthcare as well. They were a top 20 American bank. They had like over $209 billion in total assets at the end of last year, according to the FDIC. So last week, Wednesday, SVB announced that they sold a bunch of their bonds, securities, treasuries, government debt basically, and that it was going to sell an additional $2.25 billion in new shares to help their balance sheet. Everyone took their money out in a panic, and by Friday they were out of business. So why did this happen? First, you have to understand regulators have required banks to buy trillions of government debt, aka bonds, and this has caused the balance sheets of the banks to grow. Having all the bonds in their books, that comes with risks, especially now in this decade. Banks have generally figured out how to deal with this though. They just enter into this thing called an interest rate swap, and they pay this fixed percentage for the privilege of buying government debt. Gotta give it up to the US government for getting a 2-for-1 out of their banks, huh? You buy treasuries and then you have to pay to protect yourself against the risk of the treasuries you bought. What a profit, huh? God bless America. Stated a bit differently, it's like, pretend Apple, right? Pretend Apple has government power and they say, you must buy this phone. You have no choice. This is the safest phone to use and it's good for you. But the glass might break and shatter all over your face and you might lose your ability to hear forever, so you should probably buy some insurance. Either way, whether you buy the insurance or not, you have to buy this phone. It's good for you, and you have to buy it. Of course, you would also buy the insurance, especially if it's common practice with everyone else around you, right? So anyway, banks can get these variable payments in exchange for the yield, the percentage they get on the treasuries they have to buy. That's how they hedge. The trouble is, SVB didn't hedge at all. Not even once. They didn't even buy the shattering glass protection in my terrible analogy. Hopefully that lands. But of course, they didn't even have a risk manager for a few months while their portfolio grew in size. Kind of reminds me of...
Use a lot of elementary school math. Being comfortable with risk is very important.
So the whole time the Fed was raising interest rates, which I told you guys we would feel the effects of this year, this bank, SVB, basically did nothing. They were off in La La Land or something. Every rate hike that took place last year lost them more and more money. And they did nothing all year long, just while money's just draining out of their account. So for the nerds that like numbers, they had a $120 billion portfolio with a 5.6 year duration on those bonds, $80 billion of which they bought at a generational high top price like geniuses. And by geniuses, I mean the exact opposite. So with the Federal Reserve hiking rates last year, every 10 basis point move higher in the 5-year rate that they owned lost the bank almost $700 million per rate hike. So once the Fed hit 200 basis points, the bank was basically out of money. How do you just watch that happen and do nothing? So to be clear, they did not deserve a bailout. They didn't even deserve a bail-in. They weren't even trying to protect their customers. The FDIC saved the day, and it worked out for them, but they weren't even trying to protect the people at all. Kind of sounds like FTX. I almost feel like I'm repeating myself.
We tend not to have things like stop losses. I think those aren't necessarily a great risk management tool.
This isn't as bad of a scam as what Sam was clearly doing. Remember Sam and his failed scam company, FTX? Sam was meeting with Gary Gensler, the head of the SEC, the regulator that's supposed to protect Americans from those kinds of events. Well, in this case, we have the CEO of Silicon Valley Bank who actually sits on the board of directors of the Federal Reserve Bank of San Francisco, which of course is one of their regulators. So once again, we have another situation in just a span of like 3-4 months where the regulators should have seen that the bank had that risk, but of course, they just missed that for some reason. Just like Gary Gensler of the SEC conveniently missed the fact that Sam was committing blatant fraud. Oh, it was just missed it. This is an embarrassment. SVB is a banking embarrassment. So you have the CEO of this bank, when people notice the risk, telling them, don't panic.
Voy a la playa, había subido la marea.
When a CEO is losing $700 million per rate hike, and they do nothing about it, they go months without a risk manager and says, don't panic, then they're a muppet. Either they're intentionally incompetent or they're intentionally malicious, and I don't like either of those qualities in a CEO, personally. Maybe it's just me, maybe that's what other people are into, but I don't like any of those qualities. Then, the Muppet CEO sells off all of their stock in the bank before they announced that they would be selling billions of government bonds at a loss. Interesting. While we're at it, you have Gavin Newsom, who had money in the bank, calling the White House and saying they need government intervention after it hit the news that the bank was out of money. So then, the Federal Deposit Insurance Corporation, abbreviated FDIC, took over the bank and made sure everybody got paid. So you might be thinking, Sama, why you riled up? FDIC did their job. We can just move on with our lives, right? That thought is exactly why they did what they did. So you could argue they did their job to a degree. They did what they did for your confidence because they don't want any more bank runs. What happened last week was a bank run. We need to understand that. We need to dive into this a little deeper. We'll talk about bank runs in a little bit. Now, on March 26, 2020, the US banking system was changed to a no reserve banking system, which basically means banks could start doing whatever they want with all our deposits. All our money, they could just move it here, there, wherever. Okay? Over the pandemic, the demand for loans dropped, so the banks needed a new way to make some cash. They started buying assets with client deposits. The issue is that asset prices, stocks, companies, they go up and down. While the deposit, the money you put in the bank, that's what you put in. That's a fixed price. So if the stocks and assets they bought with your money go down and you want your money, then they can't pay you. Just like what happened with Celsius and other crypto banks, except this is an American bank under FDIC. But what SVB did with your money in the bank to try to make more money is earn yield, earn more profit, which means that your money is tied up in other investments. The issue comes in when you find out that the bank is at risk and you want your money all at once. When a lot of people want their money all at once. So please understand, a bank run happens when a large number of clients start withdrawing their deposits really quickly. Because the banks don't hold all that money, they actually don't have all your money in the bank for you. Especially now in this electronic age, it's just numbers on a screen, sorry to tell you, but they can't handle a large influx of withdrawals. So what does this lead to? They can't handle the short-term things that come up, like clients taking out their money. That's why the bank shut down. They were losing money and everyone took their money out. So here's where the FDIC comes into play. If you don't know, client bank deposits at US banks are covered by Federal Deposit Insurance Corp, the corporation. FDIC, they cover up to $250K in deposits. If you had a consultation with me last year, then you definitely know this because I talked to all of you about this risk. You can even put it in the comments below if you remember me talking about it and we had a session. Canada, it's $100K. It's different in every country, and you need to know how much you're actually covered for, no matter where you are in the world watching this. Now, here's where the domino effect comes in. The average person is probably not thinking about the limits on their account, but if you run a business and you have cash flow coming in and out, you probably have more than $250K in one account because you just assume the banking system is safe. So what happened? Companies with over $250,000 held by Silicon Valley Bank, they were stuck waiting for their money like a kid next to the tree on Christmas morning. When am I going to get it? If those companies had short-term needs for cash, which they pretty much all do, they might not have been able to pay for important things like their employee paychecks. This is what the Federal Reserve wanted. It is. Whether they realize it or not, by raising the interest rates, this breaks weak companies and bad investments in financial markets. This is what triggers job losses and a recession. In fact, bank crashes are actually super deflationary. They help the Federal Reserve a lot. They help them really fight inflation. Something like this in markets breaking was inevitable. I did say we would feel the effects of all the rate hikes going up last year in 2022 in 2023. Well, here we are. So this should kind of make sense. You would think, if you're trying to break things, why are you paying off more than people are holding you accountable, responsible for actually insuring? Why are you paying off more than $250K? See, 97% of people who put their money in that bank were companies. They had more than $250K in their accounts. 97% of the people with SVB had more than $250K. But the FDIC came in and paid for everything. Why would they do that? Look, I'm basically a strategist behind the scenes for my private clients, and I like to quote Sun Tzu when I work with them. I just get a kick out of it. And this whole thing reminds me of a Sun Tzu saying. Too frequent rewards indicate that the general is at the end of his resources. Stimmy checks, inflation acts, billions upon billions to Ukraine, money for refugees, reparations, anything that you can think of. And too frequent punishments indicate that the general is under distress. Just keep that quote in mind, because here's the real takeaway of the whole story.
Should be accessible when people need to know, but I don't think you have much hope of reaching a public that doesn't have a professional need to know.
I completely agree with that. I almost think you'd scare the public if you put this out. Like, why are they telling me this? Should I be concerned about my bank? Like, my insurance company doesn't tell me what they're doing with my assets. They just assume they're going to pay my claim. Right? I think you've got to think of the unintended consequences of taking a public that has more full faith and confidence in the banking system than maybe people in this room do. That we want them to have full faith and confidence in the banking system. They know the FDIC insurance is there. They know it works. They put their money in. They're going to get their money out. So there's a select crowd of people that are in the institutional side. And if they want to understand this, they're going to find a way to understand this. There's a bunch of law firms represented in this room. There's a bunch of people that'll charge them by the hour a lot of money to explain this all to them. And it's fine. I don't have a problem with that. And they all have huge staffs. But I would be careful about the unintended consequences of starting to blast too much of this out in the general public.
First off, the experts that run the show find it funny that you have more confidence in the banking system than they do.
Taking a public that has more full faith and confidence in the banking system than maybe people in this room do.
Don't be one of the people watching this video, maybe you're online or, shopping or something or traveling. Don't be one of the people watching this video that miss this very important nuance. Secondly, and here's the scary part, you can get bailed in.
Spread should respond to good and bad news about the institutions, and it's really important. I mean, it's a little bit conflicted, right? I mean, it's important that people understand they can be bailed in, but you don't want a huge run on the institution. But they're going to be. And it could be an early warning signal.
A lot of people don't know what that means. In other words, if a bank fails and the FDIC is out of money, you lose all the money you put in the bank. Instead of taxpayer money saving the bank to keep it going, no, your checking account saves the bank. This happened to people in Cyprus in 2013, and we are in an era and a time where these types of things can happen again. Third, $42 billion got withdrawn last Friday alone without anybody waiting in line to do it. That's new. Welcome to the world of mobile banking. There's no banking tellers counting money slowly. 10, 20, is it all there? That's not what we saw last week. You have people all over social media with big audiences big and small audiences like me who can reach out to people and say, pull all your money out. And people just do it from their phone. They just listen. Now, with me, I see that as a very important point. Bankers never had to deal with this before, and it scares them. The FDIC covered all depositors so that you get the message to keep calm, carry on, and leave your freaking money in the bank. That's the message you were supposed to get. Leave your money in the bank. Everything's okay. Everything's fine. If you didn't get that message, the public would have got the message I've been warning you fans of financial astrology about all last year. You would have had a much bigger panic with people pulling money out of the banks all over the country, all over the world. Aren't the benefits of financial astrology just fantastic? All the stress about your hard-earned money avoided because you've been buying T-bills at 5%, you've been buying gold and silver because you know what's coming next year. So, should you keep calm and carry on? Well, here's what you're not supposed to know about the FDIC. The FDIC has about $125 billion worth of assets. But according to this chart, FDIC insurance is currently covering over $9 trillion worth of depositors' money. Almost $10 trillion here. What this means is if, and only if, everyone, but really enough people, if a critical mass of people under FDIC insurance all rush in at once and try to claim their money at once, because a bunch of banks are failing at once, the FDIC can only cover a little more than 1%. They're responsible for $9 trillion, but they only have $125 billion in the pocket. Guys, you're not supposed to know this. If they don't have enough money to cover everybody, why did they pay more than they were supposed to for SVB? They covered everything so that you guys don't panic. The system could break in very serious ways if we panic.
I'd like to go back to some of Dick's early comments. I do think it is hard to get a lot of demand for transparency right now in this sort of period of peacetime, but that is going to flip, and it's going to flip probably even faster than we saw in 2008, where the need for communications really quickly in the social media world to avoid disinformation, to have some holding patterns for things like, I remember in the early days of bail-in, people saying they're coming for my deposits, right? So just holding communications that you can pull out that are helpful to deal with disinformation, some very simple things.
And what's the even bigger risk? Well, if FDIC and the banks fail on a large enough scale where the public no longer trusts them, what's the alternative? What's the alternative? A CBDC. Here's what you need to understand about banks, guys. Banks are really important and powerful in the world today because they get to create money. They get to decide who gets money and who doesn't. So when you have a lot of small banks spread throughout the planet, this gives a lot of options for people to get that created money that only banks can do, other than the Fed. A decentralized banking system where you have a bunch of little banks, it's actually more democratic and better for the individual. If you're a big bank and some new president comes in and says, no cars, no farting cows, no oil, no eggs, no gas, no loans to any of those industries. If any banks make loans to those industries, you're in big trouble. If there's only 4 banks in the country and the president fills those banks with their little cronies or everyone who says, yes, sir, Mr. President, then guess what? You have a world where the president can get away with whatever he or she or it wants very easily. So the big problem here is banking failures mean bigger banks step in, buy those weak banks, and these already gigantic banks become even more gigantic. And it's not just banking that's getting more concentrated. Uranus is in Taurus, remember? Food production is getting more concentrated in the US too. There's a lot of disruption. The price of eggs is like worth diamonds. Like what the hell? The more concentrated an entire industry, the easier it is to implement the public-private partnerships that this guy likes to talk about in his books, where government can control corporations more directly, aka communism. If there's enough banking problems, the politicians will then say, this is why people should get their money directly from the government instead of those unreliable banks. I'm not saying there will be a new digital dollar in this month in America, but this particular bank issue will definitely be used in that narrative to come, and it will come. Ask yourself this question. You ready? If you can't get your money out of the bank because they're being bailed in, would you accept the same amount of money you had in the bank account that you earned, that you worked for? Would you accept that same amount of money back in the form of a central bank digital currency? There will come a time when this is not a hypothetical question. Don't panic, but your responsibility to yourself is the same as it was last year when we were talking about these things together. Now, here's a caveat to that. If you see any news of a potential bank holiday from your bank saying we're closing early next week, or if the amount of daily transfers or withdrawals or spending all of a sudden is limited in your account, you have my permission to panic a little bit. Simply do what you can to make sure you have access to your money. That is the key. And this continues all the way through 2026. Make sure you have access. Even further than that, make sure you have access. We got to talk about the banks. We're going to look at some charts now. And so this is obviously a weird profession. I read charts when asked. I tell it like it is. 9 times out of 10, I tend to see things playing out either quite literally or figuratively in ways I didn't understand at the time of reading the charts. It's just weird to see things coming true almost all the time, which brings me to Jim Cramer. Who is Jim Cramer? He's, how do I put this? He's like the normies version of financial predictions, where 9+ times out of 10 he's wrong.
The 9th best performer year to date is SVB Financial. Don't yawn. This company's a merchant bank with a deposit base that Wall Street had been mistakenly concerned about. SVB, it's the old Silicon Valley Bank, recently bought one of our favorite research firms, Nathanson, and it's become less dependent upon private equity and venture capitalist offerings. Wait a second. Those dried up last year. They could come back. Yeah, some of them come back here, but the stock directly affects an oversold position. Stock was the 4th worst performer in 2022. I think the fears were not justified, and it's a very compelling situation. Hey, by the way, long-term private equity and venture capital, they're not going away. Being the banker to these immense pools of capital has always been a very good business. Stock's still cheap. These stocks should have more room to run.
Jim is wrong so much it's an internet meme. If you do the opposite of what Jim tells you, you make a lot of money. I'm seriously not kidding. I mean this literally. Look at this. You can see that he told people to buy the bank.
Good business. Stock's still cheap.
And if you would have went against Jim's recommendation, you made profit last weekend. So now that you have some context, Jim decides to go on Twitter and say JPMorgan is a fortress. And of course, this is a meme, right? So the comment section is like, please, Jesus Christ, Jim, shut up. But it's all just a fun meme, right? This is JPMorgan Chase we're talking about, right? JPMorgan's gonna be fine, right? Right? I think it's time we dive into some charts. So this natal chart is based on the last date we could find with Chase being incorporated. Chase actually has a few charts, and we looked at all the ones we could find, and they all pretty much tell us the same story when we looked at the transits. So we're going to go with the most recent chart for this video. Pluto is coming to conjunct Neptune and will be within a 3-degree orb by the middle of this year with this conjunction. Now, some astrologers would argue that because these two planets, Neptune and Pluto, are so far away, the 3-degree distance within that they're in is technically far away enough for the planets not to interact, where some astrologers would argue that the two are close enough for their energies to blend and have an effect. We'll see, but Pluto moving in the sky towards Neptune within a 3-degree orb, this could be an issue. Neptune can talk about losses, confusion, things we just don't understand. When I think about Neptune as a planet, I think about being lost at sea. I think about the movie Castaway. But what we're talking about, banking and the concern for losses, we're talking about people's deposits. And as for Pluto, well, Pluto can sometimes indicate downright stealing or a power grab or something out of your control. Saturn is coming to conjunct Chase's moon. Saturn is a cold planet. It's the furthest visible planet from the sky on Earth for human beings, furthest away from the sun visibly. Coldness is a theme with Saturn. Saturn rules Capricorn and Aquarius, right? January, February, these cold months, this cold planet. And when you're doing financial astrology for a business chart, the moon represents the public. The moon also happens to be the second house ruler of this chart, and the second house represents, in business, money in financial astrology, the money of the business. Simply, we can interpret this to mean that people's money could get frozen. The bank is experiencing frozen assets. In the progressed chart for Chase Bank, we also notice that the progressed sun is at 2 degrees of Aquarius, which means that Pluto will also join the sun in Chase's progressed chart later this summer, which represents a cleansing of the spirit or a disappearing of the vitality of sorts. We've seen this in Bitcoin before. When Pluto visited Bitcoin's sun, millions of Bitcoin were stolen from people's accounts. And then we have the South Node approaching Mars in the 6th house. In the old world, the 6th house was known as the house of health and also the house of enemies and bad fortune or bad luck. The South Node causes eclipses. For the reason the South Node has the effect of bringing latent causes and effects underneath the surface up into your face to be dealt with, because eclipses have this karmic sudden event energy to them, whether you're ready for it or not. Typically, you're not ready. The South Node tends to bring losses. The North Node brings gains, the South Node brings losses. And Scorpio is directly related to the banking system, as we've covered. So I don't like this. It looks like we have about 2 months or so before we start to really feel this particular conjunction and see what this will really bring. Now, this could be karmic events related to this guy, but I didn't want to get too tangential in this video. I'll just leave that at that. Bank of America looked at their chart as well, and they've already been showing signs of effing up.
We have this breaking news as well. Some Bank of America customers say money is missing from their accounts. People are sounding off about this on social media, and this morning we know of at least one person who says their checking account was wiped clean. We've reached out to Bank of America for comment. We are waiting to hear back from the company.
So this one's already got writing on the wall. Bank of America, also like Wells Fargo and Chase Bank, all have a Pisces freaking moon. What big, bad, nasty planet is going to sit on top of the moons of all these banks? What planet just entered the sign of Pisces on the 7th of March? Anybody know? Sade Sati, challenging times. Bank of America will also be having a nodal return. They'll have Venus retrograde on their Mars this summer in the 7th house, which represents clients and other people. Mars represents a cutting off of things. Could be the cutting off of people's money from Bank of America, or cutting off of their clients in some way, shape, or form. This could be people taking their money out of the bank, right? Cutting their ties with Bank of America. And with the nodal return, this could speak to a transformation of the business of sorts, right? The nodes cause eclipses, events that we're not quite ready for. So this could be an acquisition, maybe of another bank that's failing, right? Maybe Bank of America is acquiring other failing banks, or worst case scenario, Bank of America is the one failing and they get acquired, which really worst case scenario in my opinion would be they're being acquired by the government or the Fed or something like that, right? Look at Capital One's chart. They have a T-square during their Saturn return at the end of the year and the beginning of next year. Banks aren't looking good, guys. Wells Fargo, they've got a Jupiter return in Taurus, which would be good news, but they also have an early degree Aquarius sun. So when Pluto gets close enough to the sun in Wells Fargo's chart, this can also lead to fading away or a transformation or demolition of the spirit of the bank. And that would actually be squaring the Jupiter return, which could actually nullify any benefits that Jupiter would bring. So what does this mean? Look, those who deeply understand metaphysical principles know that ultimately, all transformation is violent. It requires a sort of self-obliteration, a crisis. When the old version is destroyed, only after that process can the new version be introduced. The bottom line is, this is what Pluto does. That is the Plutonian archetype. Pluto is going to enter the sign of Aquarius in about a week from now. There will be a detailed video of that coming out. There's a lot of good astrologers who've done a lot of really good content on Pluto and Aquarius. Take some time to educate yourself. This will be felt. Aquarius is a human sign, so don't be surprised if humanity has to deal with some version of a crisis yet again on the world stage before the month is over. But what I can tell you is this: Pluto will bring a technological change to how we do banking and how we handle our money, and it will do so by starting a crisis. And I'll tell you one more thing about Pluto changing signs. We will see AI, which is ruled by Aquarius energy, we'll see AI used to attack the financial system.
Has shaken our economies and societies to the core and shown us how vulnerable we are to biological threats. In the digital world, similar risks are being overlooked right now. A cyber attack with COVID-like characteristics would spread faster and further than any biological virus.
The bottom line is, position yourself in the assets we've been talking about, like gold. Bitcoin's starting a new bull market, but when the banks break, they will blame it on crypto. I'm not telling you to buy Bitcoin right now. I've been covering Bitcoin in my newsletter. We'll continue to talk about BTC in more videos and commodities and upcoming videos that if you invest in, you'll do just fine. But Bitcoin is complicated, so we have to really understand the nuances of that. Like I told you in the past videos, it's actively being attacked by governments. So we'll help you navigate that. We'll talk through all of that. Until next time, be well, one love.